Hello and welcome to this presentation of Wealth Legacy Group. My name is Ernest Martinez, and I'm going to be showing you how to save money, make money, create wealth, and protect wealth for you and your family. So, the reason that a Wealth Legacy Group came to be is from these three words, believe it or not. The first one is wealth. When you look up the definition in a dictionary, look it up on Google. This is the best definition that I found: is wealth is measured in time, not in money. In other words, wealth is the number of days that we can maintain our current lifestyle without having to work. If you look at that compared to rich, rich is having a bunch of money, all at once, and you can do different things with it. But what I really want us as a group to help people with is create wealth and for retirement, to have enough money to, last your entire retirement. Legacy, if you look up that word, it means something transmitted by or received from an ancestor or predecessor or from the past. So if you want to leave a legacy, you have to leave something for your family. And so we're going to show you how to do exactly that. And of course, group, it's a collection of individuals who have regular contact and frequent interaction, mutual influence, and really have a main focus or goal that everyone's working on. So let me ask you a question. In the next 5 years, where do you want to be? Believe it or not, a lot of people don't even, think about where they're going to be, next year or next month. I've met a lot of people that just live day by day. But I want you to start expanding your consciousness and start thinking ahead a little more. And in the next 5 years, really, where do you want to be and what do you want to have? Do you want to travel more, go see places? Do you want a house? Do you want a better car? Anything like that. And the biggest question is what you're doing today going to get you there? If it could, that's great, and you can utilize some of the products and services that I'll share with you. But if it's not, I'm going to show you a different way where you can, really make a lot more income than what you're currently making. So let's talk about retirement. And do you have a retirement plan right now? Did you know that Social Security, did this study and they update this study on their website and the Social Security Department? But what they noticed is following people from 18 years old to 65, this is what they found. Only 1% were wealthy, 4% were financially comfortable, 7% are deceased. So, it's hard to help them if they've already passed away. But 25% are still working and 63% are still dependent. Those people are still dependent on the government, they're dependent on their kids and things like that. And the people that are still working are the people you probably see at Walmart as Walmart greeters or at Starbucks. And ask yourself, do they really want to be there, or is it because they have to pay bills and just, kind of, go paycheck to paycheck because they didn't have a retirement plan? And so, what I want to show you is a way where you can retire and be in that top 5%. In fact, one of the plans for the company is to expand that 5%. And, where we don't have to be dependent on work or on another person. So if you look at it, only 5% are financially secure and 95% are financially insecure. And that's mainly because of education, because they didn't know and they didn't set up that plan right from the get-go. And so for the people that do have a retirement plan, this is what normally happens. They either have savings or an investment account, and they think because they save some money, aside, they have money for retirement for the future. But I'm going to give you a quick example on, normal what normal people do as far as their retirement plan. So let's say you have $1,000 starting balance that you put aside, and you contribute per month $250. Okay, so that's $250 every single month that you're contributing to your savings or investment account, and you're going to retire in 30 years. So you might be a little younger, maybe about 35. So that way in 30 years you're 65 if you want to retire at 65. And let's say on this investment account or the savings, the annual growth rate is 5%, okay? Which as a savings account doesn't exist right now. If you go over to your bank, they're probably offering you 0.001% or 0.002% on your money. If you do like any other type of investment account, they pay 2 to 7% is normal depending on what type you have. So 5% is very conservative. So your total lifetime savings that you would have saved in the entire 30 years on 5% compounded once a year is $212,000 that you would have in that time frame. Now, this is what people don't take into account. The adjusted cost of living with inflation, how much is everything going to cost 30 years from now? Okay. So let's just say that your current expenses per month right now is $5,000. Okay. And the rate of inflation is about, on average, 3% every year. And again, the years to retirement is 30 years. So the adjusted cost of living per month is $12,000. So in 30 years, the same thing that costing you $5,000 a month right now is going to be $12,000 a month 30 years from now. On top of that, what doesn't show on here is medical expenses. When you get older, the biggest expense you're going to have is on the medical side, and so you're going to be paying even more on that side. So the adjusted cost of living per year is $145,000 per year. Okay, so if you add those two together, when you put them together, really, how long will your retirement money last you? So if you have 212,000 you saved up over 30 years at the 5%, but the annual expenses per year is $145,000. So at retirement, everything's more expensive, and you're going to need more medical. Literally, that money is only going to last you not even 2 years. That's 1.46 years exactly. So, you have to do something different. And so a little bit about wealth legacy and our divisions. We have three different divisions. It's the real estate division, mortgage division, and the insurance division. But what we are mainly is retirement planning specialists, and we'll show you how to retire within different products and services, including these divisions. Okay. So I'll give you a quick plan that we do for clients. When we sit down with somebody, a new client, we help them understand that their property is actually a liability. It's not an asset. Most people have in their head that they have a house, now they have an asset. But if you look at the definition of a liability and an asset puts money into your pocket every single month, and a liability takes money out of your pocket every single month, whether you work or not. And so your house, as soon as you sell it, and yes, you have that appreciation, you get the money. Now at that point, it's an asset. But while you have it, especially if you live in it, it's actually taking money out of your pocket every single month just to keep it. So that's a negative cash flow. We try to get clients to understand as well. You have minimum tax benefits. You have minimum appreciation benefits because you only have one property. You have debt passed on to your heirs. So when you pass away, if you don't have a plan in place or life insurance or there's no equity in the property or something like that, all that you're passing on to your heirs, your family, your kids, is debt that they have to pay off. And normally it goes to number 6, probate court, where all those creditors, all those people that were owed while you're alive, they have to be paid off. So they're going to sell, anything that you have in order to do that. So what we want to do is avoid that. And so what we do is sit down, create a game plan where you have multiple assets, and you have cash flow, which is passive income every single month. That way, eventually, you can retire, and you don't have to wait until 65. Most people have this number 65 in their head. I think it's because we were taught, maybe in school, in high school or college, that's when retirement is. But you can actually retire. There's people that retire at, 35, 40. There's some people that retire at, 85, 100. It just depends on when you can and when you want to. We're going to show you how to maximize tax benefits through real estate, through businesses, through other means. How to have maximum appreciation. Have principal reduction utilizing OPM, which is other people's money. So if you look at buying a house and you have 2 or 3 properties, the great thing about real estate is you put tenants in there and they start paying rent, and so you have that rent money that pays off the mortgage. So they actually do principal reduction for you. So over time, your mortgage gets smaller and smaller, so you have more and more equity. Number 6, equity acceleration strategy. So we'll show you how to artificially create equity in the property that you have, whether it's residential or commercial. Number 7, asset protection plan. Again, we want to avoid probate court where a judge can say yes or no on anything or everything. And we want to protect while you're alive in case you ever get sued to protect those assets. It doesn't matter if you have 3 or 10 properties. If you get sued on one and all of them show, you can get everything taken away all at once. So we got to create an asset protection plan. Number 8, immediate estate fund. And so, for example, with life insurance, if you have $100,000 policy this week and you pass away next week, automatically you have 100,000 going tax-free to your heirs. So you have an immediate estate fund. Number 9, tax-free payouts to heirs. So that gets paid out, for example, life insurance. Number 10, retirement income. So the problem is, at retirement, most people that are in that age range where they're ready to retire, what they're scared of is running out of money. So we want to show you how to create an income in retirement where it can last you your entire retirement, whether it's 5 years, 20 years, or another 30 years, hopefully, that you live. We don't want you to run out of money. So we're going to show you how to do that and really have financial peace of mind and really leave a legacy for you and your family. So let's go over the first strategy that we go over clients, which is Index Universal Life Strategy. It's a combination of insurance and investment account. So there's two main types of insurance. There's temporary life insurance, as you can see on the left, and then there's permanent life insurance on the right, almost like buying or renting a house, right? So as temporary life insurance, term, it's for a certain amount of time, so you can get a 10-year, 20-year, or 30-year policy. So while you're, in the 20 years or 30 years, you're covered for a certain amount. Hopefully, it's for your entire debt, so that way if something happens, your family will get paid off everything. But it's a certain amount of time. So if you do a 30-year and you outlive that, then you just paid for being there. Just like if you rent a house, the rent that you pay there is just time being there. But on the left-hand side, if you get what's called a return of premium, ROP, return of premium, after it expires, so let's just say we do a 30-year, at expiration of 30 years, you actually have the ability to get all of the premium that you ever paid in those 30 years back to you. So at that point, you can just, have that money, and over the 30 years, if you paid $50,000 over the 30 years, you get that $50,000 back, which is awesome. Or you can go ahead and change it into a permanent life insurance policy, whatever you'd like to do. So let's go over to the permanent life insurance. So there's a lot of different vehicles. There's whole life, there's universal life, there's variable universal life. All it means is, whether it's tied to the market and what, stocks or what it's tied to exactly. But the one that's paying the most, and the thing that we recommend more than anything, is having the very last one on the bottom is an index universal life. Reason being is because the rate of return is a lot higher. It's 2 to 12% in this case. I've seen it up to 14 or 15% cap. But what's great is it'll never lose value. And the average that we've seen over the years is just what it says right here, 7.3 to 8.3%. So it'll be, way higher than a savings account, way higher than any other investment account, and it's completely safe. It'll never drop under that amount. And a lot of people don't really understand how this works, so I'll just give you a why it does that and why you can't lose any money on it is because of this. Okay. By the way, on the premium, this is just a quick illustration. This is the premium on the left-hand side that you pay, and the guaranteed death benefits. It comes with living benefits. In this case, it's $1 million, but it's whatever policy that you have. But here's the IUL and why it never drops. The gray line is just kind of tied from 100,000 to 141,000. The red is what's going on in the market with the S&P 500, the top 500 companies, and the green is your IUL, your Index Universal Life account. So when it goes up, when S&P 500 goes up, the policy goes up, so you make money in your account, right? Almost like a savings account. So, but if the S&P 500 drops, what happens is you're actually not in the market with the S&P 500. You're buying options. So if the market goes down, then all you do, or all the company does, is not exercise the option to buy. And then if it does go up, then they exercise the option to buy. So all it is options that the compound money it's actually buying. So that's actually how it works on the investment side, if you do want to understand that a little bit more. But the great thing is with this index universal life strategy, whether you die too soon, your family gets that whatever coverage you have. If it's $1 million, they get paid out $1 million. If you become ill, you actually have access up to 2% of your coverage amount every single month. And if you live too long, there's a retirement income tied to it. Okay. So I'll give you an example of what I did with a client not too long ago. He is 54, male, non-tobacco, and his face amount is $1 million on here. So he has a death protection of $1 million. So if he were to die too soon, then their family would get $1 million, which is great. And an accelerated living benefit. So while you're alive, or in this case, while he's alive, he gets accelerated benefits up to 2% a month for terminal illness, chronic illness, critical illness, and critical injury. So if something were to happen where he can't do 2 out of the 6 daily activities, which is go to the restroom or do anything where you have to live, that gets accelerated. All you need is a doctor's note, 90 days and a doctor's note, and you can start getting the benefits of that the policy of the coverage. And again, the cash value accumulation, it's basically like the investment side of the policy. In this case, at age 100, he would have 7.4 million, so it would accumulate a lot of money, and it's all tax free because it's tied to a life insurance policy. If this was a regular investment and he was actually making this money, every time you sell a stock, you have to pay taxes on it, right? But on this, because it's tied to the life insurance and it's in there, and when you do take money, you borrow the money from it, it's tax free because it's tied to life insurance and you're just borrowing from the policy. So that's how it works. Now let me give you our real estate wealth strategy that we share with clients. Very, very powerful illustration that I have here. And it definitely works. I'll give you a quick example. My grandma and grandpa is our original teachers for this. They actually bought 2 properties, right in front of them. So they basically did this with the same house. They borrowed some money, bought some properties. In this case, it's 3. They only did 2, and they have 3 altogether, and they're completely paid off. They've been paid off for about 20 years, and they never refinanced after that. So they just have money coming in, which is passive income. So this is what we highly recommend for anybody because we know it works. So if you refinance or if you have money where you can buy other property, this is what will happen, okay? When you buy these other properties, once you put tenants in there and they're paying for the mortgage, you're going to have extra money, which is called passive income. And it's going to go ahead and eventually it's going to pay off, your first property. And you're just going to do this domino effect. And the great thing is every 5 years, you can either on each property, you can refinance and lower the payments where you have more cash flow coming in to pay for your main residence. And also on all the properties, you have appreciation. So everything is going up. So if it's going up, 10% a year, your first property and the other properties are doing it. So you're building more equity and all the tenants are paying for the other properties. So the mortgage is being paid off faster. So you're creating even more equity. So it's a great strategy to have. And there's people that retire every single day with this. In fact, more millionaires are created within real estate than any other type of business. Okay. If you want to take this a step further, what we recommend is, when you have these properties, it's great, but what you want to do is do an asset class transition. So if you transition it into, over 5 units, in this case, apartments, what happens is with regular real estate, with houses, residential 1 to 4 units, the little problem that you have is if the market goes down, your neighbor's property goes down, then automatically yours goes down because it's supply and demand. So it's completely tied to the market and it's pretty slow. But if you look at apartments, they're actually based off of income. So, even in a good market or a bad market, you can actually raise rents. If you raise, let's just say, they're both 100-unit properties and you raise the rent $30. And I want you to think about this even as a renter. When you leave, a property, if there's new management, they raise it $30, and they start cleaning up the front, they start doing stuff to make it more valuable. Are you going to move for $30? More than likely, no, right? You're not going to move for $30, especially if they're showing value. On top of that, if you own an apartment, you lower the expenses, and there's different ways to lower expenses. But if it's something small that you can do to lower the expenses, like maybe the current property management is charging too much there, so maybe you'll save a little money there. But I'll give you a quick example. Let's say both of these are 100 units. So, and you raise it $30. So $30 times 100 units is $3,000 a month. So you just, increase your profit every single month, $3,000. Multiply that by 12 months, that's $36,000 a year that you just raised it. Okay. And it works off of caps. Okay. So if you divide that by 10%, you just raise the value of your apartment $360,000. So as you can tell, when you do an asset class transition, you can control your property and the income a little bit more than regular properties. It is easier to get into a regular house, but once you get going, it's better to get into a different class of real estate. And then all the money from that will obviously pay for your lifestyle and your other properties. And the last one on here, with the rental coming in, you want most people get into real estate for the rental income and future appreciation. But eventually they don't want to deal with real estate. All they came in, is for the actual money. So what we do is we set them up as owner financing income with interest payments. So they basically become the bank, where instead of owning the property, they still have a lien on the property in case they don't get paid, just like the bank does. But now they're just getting money and interest payments, and that's all they're looking for in case you don't want to deal with tenants in the future, which when you're around retirement, that's what you want anyway, right? So this is another retirement income that will last literally forever. So when you add all of this stuff up together, this is how it works, okay? And I'm just gonna have a small illustration on it. I'm not even gonna put apartments in here or big policies. So with real estate, mortgage, and index universal life, when you put it all together, the first year, let's say you put $50,000 into real estate. It should be a lot less. If we can do FHA 3.5% down. You should be normally less than 10 or 20,000. But let's just say on the high end, $50,000 a month here. I mean, sorry, one time to get into the property, and you have a mortgage, and it comes out to in this case 2,900. And let's say you have an IUL, and it costs $500 a month. Okay. So year one, you have a real estate property. It's worth 500,000, and I wanted to do the math very simple on this. So if the market goes up 6.85%, and it does this every single year, the mortgage you're paying 6.85%, and then the IUL is paying you 6.85%. I wanted to do it very easy. With real estate, year one, it's $34,000 that you made return on investment from the 6.85% on your 500,000, but it's all in equity, right? So it's still there. You haven't actually cashed out, so it's there in the property. But if you look at the cash on cash return, this is when it starts to get exciting, because you made $34,000, in the property, and you put in this case, 50,000. You've actually made 68.5% on your money. So you've actually almost, made your money back on there. Plus you have cash flow, and other people's money are paying the mortgage. So in this case, the mortgages is leverage. Your IUL is also giving you living benefits. So let's fast forward. This is the really, really exciting part. 30 years from now, okay? Let's just say this happens and the market goes up. Over the next 30 years, you have a real estate property that's worth $1.5 million. You can see on the bottom, green. The mortgage is paid off in the case that if you didn't refinance. Some people refinance every 5 years to go to Vegas. But if you can pay it off, the sooner the better. And your IUL will have, in this case, $458,000 that's accumulated inside of it on the cash value side. And the actual value of the coverage will actually go up over time if we set it up that way as well. So just by doing this one thing, having one property, you have a paid off mortgage, you have a property worth 1.5 million, Even if you did this one thing at retirement, and I want you to really think about this. You have this, you still have tenants in it, you'll be making $2,000-3,000 a month. You can some people could retire just on that, and you'll have a property worth $1.5 million. If you ever need money, you just need to refinance it, and if you need a little quicker money. But you have your retirement set on this. And now imagine if you do this 2, 3 times, 10 times. Okay, a great way to do it. So some very exciting stuff. Something that no other company is offering. We have a rewards program with Wealth Legacy Group, and this is the way it works. Clients that earn reward points, the way you do it is if you refer a real estate transaction, a buyer or seller, as soon as it closes, you get 1,250 points. Okay. Well, in the future, we're going to give you a login. You'll be able to see your points accumulating and all that good stuff. And you can transfer points with other friends and family. And I'll share with you why you would even do that. But you get 1,250 points for real estate, 1,000 points for mortgages, and 250 points for any life insurance product. So life, IUL, annuity, or anything like that. So here's the exciting thing about having these reward points. These reward points you can accumulate even as a client, and it's point for point, dollar for dollar. So 1 point equals $1. So in this case, let's say you accumulated 10,000 points. That means you have $10,000 that you'll be able to work with when you're buying or selling a house. So I'll give you an example. Let's say over the next year or two, you refer 5 people, 5 buyers. Okay. So if you refer 5 buyers, those 5 you get, let's just say 1,000 points for real estate and 1,000 points for mortgages. You get a little bit more than that, but 2,000. 2,000 points times 5 people is 10,000 points, right? So over the next year or two, you can do that even as a client, refer 5 people. So let me ask you a question. What's easier, okay? Trying to save $10,000 to buy a house, or referring 5 people and getting 10,000 points, which is $10,000 in escrow. Okay, it's a lot easier to refer 5 people. That's what's so exciting about this. And so when you actually go and buy or sell a house, what we're gonna do is when we represent you, we're gonna put our own commission in escrow up to that whatever amount of points that you have. Okay, and that's how it works. Now, some people want to take it a step further, and actually, make money with us. So let me share with you as a marketing associate. And really, each individual division has its own comp plan. So I'll share with you that on the compensation plans. So if you want to actually be a marketing associate, basically a salesman, there's 2 ways to do it. Okay, either as a member, and as a member you're just a client. So anybody can do this. Anyone that wants to earn points by referring clients, you're automatically a member. Or a marketing associate. So when you're a marketing associate, you actually have to sign up. We'll have to do an interview. So you'll have access to leads within each division. There's going to be scripts. You can set appointments, and you set appointments and you assist licensed personnel depending on the division. And so here's the compensation guidelines. Your own personal points, client points, and hierarchy points, if you decide to build a team, count towards these promotions that I'm going to share with you. There's a 33% rule applied to hierarchy points. So for example, let's say that you decide to build a team and you bring 3 people, and each one of them bring in 1,000 points each. Okay, that's only one each. So 33% of that would count towards your own points. Okay. Marketing associates must maintain points annually to keep respective monthly incomes. Okay, so what are the monthly incomes? So when you hit district manager, the very first one, you'll hit 25,000 points and you'll be making $2,000 per month. Okay, guaranteed in the next 12 months after you hit the points. And so if you want to keep making that monthly income, you just got to hit the points per year. Okay, it's a lot simpler than it sounds. If you want to hit regional executive, once you hit 50,000 points, you get that title, regional executive, and that's $4,000 per month. And to be a vice presidential in the company, You have to hit 100,000 points, and that's $8,000 per month. But again, the exciting thing is your points, your client's points, and your entire hierarchy points. It doesn't matter if it goes down, 10 levels down. All those points count towards you. The 33% rule is there, but that's only because, let's just say, if I hit vice presidential and then somebody else, actually, let's just say I bring somebody and they become vice presidential, so they get 100,000 points. That means if we didn't have that rule, I would automatically become a vice presidential, but the company wouldn't be able to pay out that much like that. So we have to add the 33% rule there. Okay. So very simple. You do not have to be licensed as a marketing associate. You don't have to be licensed in any division on here, but these are the pays. Okay. Now, if you decide to actually get licensed, get your real estate license in this case, and join the real estate division, the one that we utilize is Superior Properties Group. We do residential and commercial real estate there, and the actual comp plan is 55% to 100%, but you do have to be real estate licensed. So I'll give you an example here. Let's just say you're a part-time starter agent, you're a licensed agent, you're just helping one family per month. Okay. Now, 12,000 GC, all that means is gross commission. So as you can see on the very bottom, if you base it off of a $400,000 sales price of a property, you multiply that by 3%. That's what normally real estate agents get paid. 3%, that's $12,000 of gross commission that comes into the office. Okay, so it doesn't matter whether you went with Century 21, Remax, Keller Williams, any of those companies. There's gross commission involved. So in this case, $12,000. Let's just say you're at a 60% contract. By the way, it's very easy to go up in contracts in each division. From 55 to 60, you just have to bring in, I believe it's like two transactions, one or two. So it's very easy to do. So at 60%, 12,000 times 60% is $7,200. Okay, so if you're doing one family per month, you're making $7,200 a month. You multiply that by 12 months, that's $86,000 a year you're making starting off, assuming you just stay at the minimum of 60%. Okay. Once you get a little bit more experience, you become an experienced agent. Let's just say in this case, you're helping two families per month, so one every other weekend. Same gross commission of 12,000, but now you're at a higher contract, so that's 70%, and you're helping two families a month. So now you're making $16,000 a month. You multiply that by 12 months, that's $200,000 a year as an experienced agent. Okay, and that's only what 24 families a year. Definitely doable. Some agents, rock stars are doing that per month. Okay. And as a full-time rock star, licensed agent, you're helping four families per month. So maybe, every weekend, either showing properties or doing open houses or anything like that. Same gross commission, so $12,000, but let's say in this case you're at 80% contract and times the four transactions, that's $38,000 a month. Multiply that by 12, that's $460,000 a year you'll be making as a full-time rock star. Okay. And great thing about the real estate division, we actually have a mortgage bonus plan. So if you have a buyer and they bring a mortgage in and we help them within our mortgage division, you get a 20% bonus, real estate bonus. Okay. Now I want to be clear with you on this because there's other companies that are paying out mortgage bonuses without being even real estate licensed. You're not even allowed to get paid anything on the mortgage side if you don't have a mortgage, your NMLS license. Okay. So the way we structure it is there's two sides. There's a real estate commission and then there's a mortgage compensation. We actually don't touch the mortgage money at all. All we do is raise your contract, your commission on the actual transaction as a real estate bonus. Okay, so I want you to really understand that you're getting a real estate bonus because you brought a mortgage. You're not getting paid on the mortgage. Okay, although it basically is the same thing. Okay, so in this case, you must have your real estate license. So let's just say in the same example I already shared with you, you're getting paid the 60%, but when you add the 20%, that's really 80% you're getting paid. So that's $9,600 a month Multiply that by 12, that's $115,000 a year. Okay? Experienced agent with that 20% bonus, that's $259,000 a year. Full-time rock star with the mortgage bonus, you're at 100%. That's $576,000 per year you're making just with that extra bonus on there. Okay. And by the way, I want you to understand there's people that are doing 10, 15 transactions a month. Okay. You don't really have to stop at 4 families a month. Okay. Now let's talk about our insurance division. Okay. The company we're utilizing is their name is Family First Life, and you do have to have your life and health license. If you're already licensed and you have your life license, you can still, work with the company. You just can't offer all the products. But the main things that we offer is mortgage protection, insurance, annuities, and life insurance. Okay, and you get paid on personal production 80 to 140%. So if you're a part-time starter agent, you're helping 1 family per week. And the reason why it's changed on per week on this one compared to per month on real estate is because in insurance, we actually get paid um, after it's issued, 48 hours after. Okay, so we actually get paid even faster than per week, actually. But just to make math easy, 1 family per week. So the way insurance works, for example, if somebody gets $100 a month policy, that means $100 times 12 months means that client is paying 1,200 in annual premium. So the insurance companies actually pay a year in advance to the insurance division. So let's just say you have 1 client, 1 family per week. So 1,200 annual premium, and you start at 80%. So multiply that by 80%. That's $960 you get paid on that. So if you're doing that per week, that's 3,840 a month. So just 960 times 4 weeks. And then if you multiply that by 12 months, that's $49,000 per year, helping 1 family per week. Okay. If you become an experienced agent in the insurance division and you're helping 2 families per week, that's 1,200 in annual premium times 90% times 2 families. That's 2,100 a week, 8,600 a month, or $112,000 a year. Okay? And last one, full-time rockstar, helping 4 families per week, 1,200 in annual premium times 100% times 4 families. That's $4,800 a week, 19,000 a month, and $249,000 a year as a full-time rockstar at 100%. And again, you can actually go all the way up to 140% on here. So you get paid more than a year in advance in this case. And we get paid within about 48 hours after issuance. Okay. But the great thing about this is, once you get your retirement going, I mean, you can really set a goal and retire in 10 to 15 years. And you don't even have to wait till 65. And if you're already in that range, you could, and we can help you do that. The reason why I want to help people retire and I want to retire is to go see the world. I mean, most people, they wait to work, for 40 years just to go and start traveling. But if you start making the money that, you deserve by helping other people get what they want, you'll be able to do that even before retirement. Okay, so you can go and see Egypt and Paris and Peru and all these cool places. And now, where are you going to be from 5 years from now? It was the very first question that I asked you in the beginning of this presentation. And is what you're doing today going to get you there? And what I just showed you is a way where you can protect your family from loss. You can, really set up a retirement passive income, whether it's through insurance or real estate. And you can really create a wealth legacy for you and your family. And so, what's next? Complete the presentation survey. Get back to the person that brought you to this video. I'm also going to have under this presentation survey, and let us know. I mean, if you want to set up a retirement plan, we can sit down, create a personalized retirement plan for you, depending on what you do, how much your expenses are, how much your income is, and we'll give you the exact year and month you'll be able to retire if you do that. If you're interested on the real estate or on the mortgage division, let us know whether you want to buy or sell a house or you want to be a part of it in your license. On the life insurance, we can get you a free quote and see exactly how we can start helping you on that side. Or if you just want to make money with us, you want to get a license, maybe you want to join a division, wherever you think you fit, just let us know and talk to the person who sent you over to this video. And really, there's two choices, and I always have this choice every time I see any type of business opportunity presentation, whether it's live or on video like this. And there's really one of two ways it can go. Either you see this, you thought it was a good idea, you might implement something, but you literally 2 years from now, 3 to 5 years from now, you'll be in the same position because you didn't take action. Okay. I hope you think it was a great video and great stuff, but hopefully you take action on it. And then the second way is to, literally decide, and all it takes is a decision. Just make the decision that, yes, I want to change my family's future. Yes, I want to retire and create a plan. And or yes, I want to start, creating a part-time or a full-time income, utilizing one of these divisions and make, a good legacy, make some great income for me and my family. So if you are that second person and you want to start working with us, let us know. Get back to the person that brought you to this video, and hopefully I'll be shaking your hand soon and saying welcome to the team. Okay. Thank you and have a great day. Bye.